Hey there, and welcome to another episode of Lever Time, the flagship podcast from The Lever, an independent investigative news outlet. I am your host, David Sirota. On today's show, some continuing coverage of the bank panic of 2023. We have a terrific guest, a really important guest, Saule Omarova. She's the Cornell Law School professor whose name may sound familiar to you. She was nominated to be one of the federal government's top bank regulators, but her nomination was blocked by Senate Republicans and corporate Democrats. I talked to her about what regulators could have done to halt this current bank crisis and what can be done to prevent future crises. This week, our paid subscribers will also get a bonus segment. The Lever's Julia Rock and I go over one very big question. Should Federal Reserve Chairman Jay Powell be fired? And how could a president fire a Federal Reserve chairman? That's coming up on our bonus segment for our paying subscribers. If you want access to Lever Time Premium to get those bonus segments, you can head over to levernews.com to become a supporting paying subscriber. That gives you access to all of our premium content, and you're directly supporting the investigative journalism that we do here at The Lever. Speaking of which, if you're looking for other ways to support our work, share our reporting with your friends and family, leave this podcast a rating and review on your podcast player. The only way that independent media grows is by word of mouth, so we need all the help we can get to combat the inane bullshit that is corporate media. I'm here today with Lever Time's producer Jared. Hey, producer Jared, how you doing?
Hey, David. So I got some interesting news for you with some analytics I was looking at the other day dealing with Lever Time and its audience growth. And some interesting things that I noticed is, Lever Time, the number of listeners across all the different platforms, it's, been growing steadily over the last couple years, adding subscribers and new listens every single month. But then in February, something crazy happened where it just shot up 30%. And we just got a bulk of new listeners out there in podcast land that have found their way to Lever Time and new subscribers. And I think it really has to come back to all the breaking news reporting that has been done on Norfolk Southern and the banks.
I mean, we've been on really a kind of an incredible streak. I mean, it's actually started before that. We broke that big story about Pete Buttigieg and Southwest Airlines, the attorneys general pushing him to crack down on the airlines, pushing a push that he basically ignored. Then we did the East Palestine reporting. Then we did the Silicon Valley Bank reporting. It has been an incredible run, and you love to see it in terms of the podcast subscriber growth. That is great. So everybody who's listening, who's spread the word about Lever Time, thank you so much. It's obviously helping. It's obviously working. And I should mention, it's influencing the policy debate. I mean, there's bipartisan rail safety legislation in the Senate now that is in part a result of the reporting that we're doing and the reach that our work is having.
Yeah, and speaking of the word getting out, there was a really interesting David Sirota profile in the web on the website Airmail, and I'll go ahead and read the title here. We'll drop a link in the episode description because everyone should check this out if you're a Sirota fan. It's called "Politics by Other Means." Is David Sirota, whose 2-year-old news site The Lever has been ahead of the media pack on several recent stories, a journalist or an activist? The answer is yes. And David, the thing that surprised me the most was the byline on this article, Brian Stelter.
Right. If people hear that name, it sounds familiar. That's the former CNN host of Reliable Sources. He was a New York Times writer. Listen, when Brian called me up and said he wanted to do this profile, I was a little bit circumspect. I was like, oh no, it's going to be like making fun of us or sort of criticizing us. I was actually really pleased with this profile. And I had a couple of people say, wow, you're like a real fancy person now because you're in Airmail. For folks who don't know, Airmail is the new publication by the former longtime Vanity Fair editor, Graydon Carter. So a couple of my friends were joking like, wow, you're such a fancy person now. You're in
among the
airmail.
media elite there,
Yeah,
David. And it's also like, I what I loved about it was like, Stelter quoted some other people referencing you as, quote, pugilistic, intense, and even obsessive. But, you're also funny and humorous. So he got both ends of the Sirota personality there.
You can only survive reporting what we report with having a good sense of humor. That's for sure. So I try to keep a sense of humor, even though sometimes it can be a dark sense of humor. I hope people will go read the article. Again, it's in the episode description. Take a look at it, because it does take seriously the work that we do here at The Lever. And it talks a lot about our growth and what we're trying to accomplish. So take a look at it if you can.
Yeah, and the other people reading The Lever religiously were Representative Ro Kahana on a live call-in show that we had on Friday about the SVB banking crisis. He also name-checked The Lever's reporting, calling it a must-read.
Thank you. Thank you to you and Lever for the reporting. It's been one story after the other. Now you're a must-read.
Yeah, and I appreciate that. I mean, listen, Ro Khanna on that call-in. I mean, what I appreciate about Ro Khanna is I don't agree with him on everything, but he always makes himself available to be on independent media. And I think when he said that about our work, I think he was reflecting. Listen, he's reflecting something that I've always believed in, which is that if you break big stories on and you surface important information, it can ultimately travel around. But it is a lot of work. It has been a big slog to get our work out there.
And Ro Kahana was an interesting person to talk to in the wake of the banking crisis here, because while at once he's both a progressive lawmaker, he also represents Silicon Valley there, and is very familiar with the same types of VCs and other financiers that got in so much trouble with their deposits at Silicon Valley Bank. So it was interesting hearing how the questions you asked him, and also in the chat some of the ways that people were perceiving Kahana in the scheme of this moment.
Yeah, I mean, he's in a position where the bank is in his district, literally. The bank that collapses in his district. A lot of businesses in his district do rely on financial services at that bank. But he also voted against deregulating that bank. We talked a lot about universal deposit insurance. We also talked about whether Jay Powell, the Federal Reserve Chairman, should be fired. He took the position that it might destabilize the markets. I take the position that it's kind of ridiculous to argue that we can't fire the Fed chairman who destabilized the markets because it might destabilize the markets. That's kind of a tautology that I don't subscribe to. Like the guy, Jay Powell, more and more seems like a chaos agent in the entire financial system and the economy. But we talk more about that in our bonus segment with Julia Rock, whether Jay Powell should be fired. For those who are interested in that topic, go to the website firepowell.com, and you will see our open letter to Joe Biden about the question of whether Jay Powell should be fired. Okay, let's stop there because I want to get to our big topic of the day. What regulations could be put in place to prevent the kind of bank crises that we have seen over and over again over the last many years. We're going to talk to the person who was the nominee to be a top federal bank regulator, whose nomination was blocked because she was pushing for regulations that Republicans and corporate Democrats thought would be too tough on the banks. Up next, our interview with Saule Omarova and Matt Stoller. Welcome back to Lever Time. For our big story today, last week, as news spread about the ongoing crisis in the banking system, we reached out to two people who know what's really going on and what can be done to prevent these kinds of emergencies from happening in the first place. Cornell University Law School professor Saule Omarova and Matt Stoller, an analyst and researcher who writes frequently about financial regulations at the American Economic Liberties Project. If Omarova's name sounds a bit familiar, that's because she was nominated by President Biden to be one of the federal government's top bank regulators. But her nomination was blocked in the U.S. Senate by Republicans and a group of corporate Democrats. They opposed her because she was promising much tougher bank regulations, which might have helped prevent the current bank crisis. In this discussion, I talked to Omarova and Stoller about the bank industry's lobbying and deregulation that led to this crisis, and we discussed what can be done to move us away from never-ending financial panics. The first guest that we have is Saule Omarova, who was a Biden nominee to be one of the top financial regulators in the country, but whose nomination for the office of the comptroller of the currency, whose nomination was blocked by a coalition of Republicans and corporate-aligned Democrats. We also have Matt Stoller of the American Economic Liberties Project, who writes extensively on all of this stuff at his terrific newsletter called Big. So both really terrific experts. Are pleased to have them here. I think, Julia, you have the first question for Professor Omarova.
Yeah, thank you so much for joining us on this call, and we're really excited to have you. So your nomination to the Senate was blocked sort of in part because banks did not like the way you were talking about, systemic risks in the financial system and some of the sort of bigger picture problems in the financial system that were creating different types of risks. I'm wondering if sort of any of the topics that came up in your confirmation hearing, or that banks were concerned that you were going to take action on as a regulator, had any bearing on what just happened with Silicon Valley Bank, and if there were things that in just the past, I guess, year and a half or so since the nomination was blocked that you think regulators should have been doing differently.
Well, thank you so much, David and Julia, for having me on this wonderful show. And Julia, of course, you're asking the question that's not at all complicated, right?
Yeah, it's an easy one.
That's right. During my nomination, as you already said, I was basically portrayed as some kind of bank-hating person for proposing various ways to kind of minimize the risk of bailouts. And what was thrown into my face repeatedly was that, we don't need this radical reforms. We don't need these crazy ideas because everything is going just fine. And of course, now we see that nothing is really going just fine. And in particular, this deregulatory bill during the Trump era that was passed by Congress in 2018, that sadly and sort of unexpectedly at the time for me became the sort of lightning rod of all these attacks on my not just integrity, but mostly even on my competence, which was kind of ridiculous. So I did testify back in 2017 in the Senate hearing, specifically against this idea of deregulating large and so-called mid-sized banks. And one of the basic arguments I made was, look, $50 billion, not chump change. And certainly $250 billion is a lot of money. And also that we should never really, listen to just the regulated industry telling us that regulation is too expensive, that they actually have everything under control, and that their private profit-making interests are somehow naturally and constantly aligned with our interest in financial stability. And of course, nobody listened to me then. And then when I was going through my nomination, that was brought up as some kind of an instance of my incompetence. So what if this 2018 law was not passed, right? And we still had those original Dodd-Frank Act regulatory and supervisory constraints on banks like SVB or Signature. Well, first of all, maybe they wouldn't have grown quite so fast, quite so big, because once Congress basically lifts the threshold above which you as a bank are considered systemically important, then there is a lot of room to play. Right, so quickly within a few years, Silicon Valley Bank grew from $50 billion all the way to $200 billion. Market rationality tells us that this is probably a very risky enterprise. You cannot grow so fast without incurring certain risks. But at the same time, conveniently, the same the same legislation enabled the regulators, including the Federal Reserve, to roll back a lot of the regulatory constraints on what banks could do. For example, like you said, David, the liquidity ratios and various other stress tests requirements, and all of that stuff was either lifted or significantly weakened for Silicon Valley Bank and Signature Bank and similar banks. So now, of course, the question what to do, the first and the easiest answer is, well, first of all, let's just go back to where we were back in 2018. It wasn't perfect by any means. It was not perfect, but let's at least restore certain prudential, supervisory, and regulatory requirements that could tighten some of these prospects, business prospects for some of these banks. And I agree with that. But I also think there are bigger questions to be asked. And you've been asking Rohana about his views on this universal deposit insurance proposal, for example. And whatever one might think of it, it is an example of how at least the rhetoric of the political debate is shifting today as compared to where it was several years ago, and even in 2008. And it's kind of interesting because, if you think about it, this particular crisis was not, and so far, thank goodness, it's not yet quite as systemic and quite as devastating as the crisis in 2000 was. And yet we are prepared to push a little bit further in our conversation about what is possible, what is feasible as a response. And I think it has a lot to do with the optics, which are super important, of course, but also with our learning curve, right? One time after another, yet another time, in the last 15 years, how many times have we experienced this kind of a situation where some structural problem surfaces and somehow those with the loudest voices and deepest pockets get away with a lot more than what regular folks can get away with. And I think this is where we should cherish this moment to the extent that there is anything positive to be taken out of it as an opportunity to push further. And I'm happy to talk about what you think or what I think that might look like.
Before we get to that, I want to bring Matt Stoller into this conversation. Matt Stoller, the American Economic Liberties Project. You have written critically about the entire role of the Fed, where the Fed exists in our politics. I think it's not all that widely well understood. But to put a fine point on the question about, for instance, the Fed, this question about whether it's the regulations or the regulators. I tweeted out today the old picture of the two Spider-Men pointing at each other, right? And it's one, the politicians, saying it was the politicians who deregulated these banks, pointing at the regulators, saying the regulators weren't doing their job. They had power to do their job. Then you've got the regulators pointing at the politicians, saying, no, it's the politicians who deregulated these banks. So I guess my question through the prism of, for instance, the Fed, the top bank regulator, is it the deregulation or is it the regulators? I'm guessing you're going to say both, but where do you come down on that discourse?
Well, the Fed wrote the 2018 law, right? The Fed always hated Dodd-Frank. They never thought that the banks were the big banks were the cause of the financial crisis in 2008. And so they always wanted to roll back these rules because they think that the large, powerful banking institutions represent the strength of America, and they want to do everything they can to help them. And they think it's unfair that they're placing constraints on them. The way I think about the Fed, well, I mean, I have many ways of thinking about the Fed, but the best analogy was from someone who's in the regulatory agencies who said that the Fed is kind of like the parents of Veruca Salt in the dad of Veruca Salt in Willy Wonka. Right? Who just constantly indulges his incredibly spoiled child. I think that's kind of the best analogy, but just institutionally, the Fed, I was pretty angry about this bailout, but one of the things that's been really nice to see, and I think I'm pretty optimistic about it, is just how much anger there is at the Fed, how obvious it is that the Fed is a disaster. And a lot of people that are pretty cautious are starting to say we need to take authority away from the Fed. Because if you think about what happened in 2008 and you think about the last 10 years of economic policymaking and you think about policymaking in general in our democratic society, it's really the province of central bankers and judges. And that is a pretty dangerous way to run a culture. And so having people notice that the small group of technocrats at the Fed are institutionally conflicted, and I can go into that if you want, but they don't, basically they can make a mess and don't have to clean it up. The FDIC has to clean it up. They are highly deferential to people with capital, and they effectively like the fact of 4 government agencies called JP Morgan, Bank of America, Wells Fargo, and Citigroup that we can ask to do things for them. That is who they are. That is how they've structured our society. And there is now criticism of that. So I'm very happy about it. But we have to recognize that we have this rogue institution that has bankers on the board. I mean, the head of the Silicon Valley Bank, the CEO, was on the board of the San Francisco Fed that regulated him, which is totally crazy. And they call themselves independent of political control, which is also crazy, because this is who sets monetary policy and employment policy and has bank supervisory authority over the largest and most powerful institutions in our culture. And somehow we have this they have such mystique that we all say, oh, they should be allowed to make decisions over our lives without our ability to influence them through elections, which is also crazy. And so I'm glad that now that there's all of this exposure about just how bad they are at their jobs on essentially a competence level, that they're getting exposed, and we can maybe start to have the deeper conversation that we started to have during the 2008 crisis, but never finished.
So pivoting a little bit from that, Professor Omarova, I wanted to ask you about something sort of made my jaw drop that I saw you tweeting about, which is that in the wake of the FDIC's takeover of Silicon Valley Bank, the sort of new bank that's in existence bragged, this action by FDIC effectively means that deposits held with Silicon Valley Bank are among the safest of any bank or institution in the country. We are actively opening new accounts of all sizes and making new loans. The bank is now marketing itself as the safest place to transfer your deposits, fully insured with no limits or caps. What do you make of this? What does it say about proposals like universal deposit insurance? Sort of how did we end up in this situation?
So the reason I tweeted out this or retweeted that piece of information was that I just thought that was just so indicative, right? Like getting to the very core of the problem here. Look, the reason why it's possible to turn a dying bank suddenly into the safest bank on the planet is because there is this explicit putting forward of our power, public power, to back up private institutions' liabilities, explicitly put behind this particular bank, right? And this is where a lot of these proposals that currently are circulating about universal deposit insurance, basically, they're playing up on that notion. Look, we do it anyway. When a particular bank is about to fail and deemed systemically risky, we just go ahead and basically show the world that what we pretend to be private bank-created deposit money, in fact, really is sovereign money, the money of the public. And so it becomes that way when there is a difficulty, right? So removing that fiction, on the one hand, I'm sympathetic to that idea to the extent that it would actually just allow us call things as they are, rather than pretending that there is some kind of, market discipline or whatever. But I worry about that precisely because of what happened with the SVB and its claim immediately turning around and trying to turn this public backup, explicit backup, to its own benefit somehow. And the reason I'm worried about this is that there are risks. There are risks to removing that ambiguity, even if it's fiction, even if we all know that ultimately the FDIC and the Fed and the Treasury will come in and bail out banks. There is still some notion that, look, once we admit to it, then we really need to figure out a way of really regulating these banking institutions, not as some kind of private companies that are, living according to market discipline, but as really purveyors of a fundamental public good, a form of public utility. And we've stopped looking at banks this way a long time ago, certainly in the last 25, 30 years. And so if we extend deposit insurance to all deposits, no matter what, all banks, no matter what, then we have to really think about what kind of activity limitations we will impose on those banks, how we're going to really keep them, basically tethered to that kind of public utility role and not allow them to incur or create risks out there, because there is a risk of new forms of regulatory arbitrage. I don't know if we can anticipate all those shifts in the incentives that will happen once we declare all deposits out there fully and explicitly protected by the public. Will that necessarily kill too big to fail, like JP Morgan? Or will it actually allow JP Morgan to start using that explicit guarantee to create yet more riskier financial products and offer those products to a variety of its potential clients and say, look, it's expensive now to have this fully protected, explicitly protected deposits because FDIC is charging us more. So instead of keeping your money in those expensive deposits, how about you do X, Y, Z? So this is the concern that I have, and I'm not sure that it's really the only solution that we should pursue. But having said that, I think what we really need to think about is public option for deposit money. And that is where I think we need to kind of look at technology and look at how we can recreate, be it a postal banking, be it some kind of a CBDC kind of a thing, or whatever it is. But we need to start thinking seriously about public option for the safe, liquid transactional deposits.
Let me turn back to Matt Stoller. I'll just piggyback off that. This question of universal deposit insurance and the potential downsides of it. Just tell us your thoughts on that.
Yeah, so I, in many ways, I agree with Saule on that. I would be very nervous about it because banks, what we call banks are not banks. They are, there's like a core of banking service, which is managing and facilitating payments, a place for self-keeping, some basic lending. And then they've built on that core a huge amount of other stuff, which is essentially forms of risk-taking and gambling. And if you just have the business of banking, you had a bunch of very simple banks, which is kind of what we had in the middle of the 20th century. You can only do, if you're a commercial bank, you can only do certain things. If you're a thrift, you can only do certain things. You can't take demand deposits. If you have very prescriptive rules that say in your charter, you are only allowed to do X and not outside of that, then I think you can do universal deposits without too much risk. But you can't regulate what we have. These are these giant monstrosities that are just far too complex for even the people running them to know what's going on. So like Silicon Valley Bank was a hedge fund attached to a government guarantee, right? And that's not what a bank should be. A bank should be a place for safekeeping. It should be a place that if you have a business, you need like a payroll account or you need a transaction account, you can just use that, like you get service and you can just, it's a place for transactions. What I would think, if you do universal deposit insurance, then what'll happen is a bunch of deposits will flood into the system from the shadow banking system. And then bankers will have to put those deposits to work and they will put that in riskier assets. They'll bet on commercial loans or whatever it is that they bet on. And our regulators, I don't know if anybody's noticed, they're not up to snuff on this. And I don't even know if you could regulate this system, even if you had aggressive regulators. But that would be my worry. I think there are a couple of options that we could go with, which is one is to try to kind of take out only insure the kind of public utility aspects of the banks. So you would just put the FDIC had this program from 2008 to 2010 where they were like, okay, if you have a business account and you're not getting interest on it, so you're not looking for a return, but it's used for payroll or it's used for escrow or it's used for lots of transactions, we'll back that. That's backstopped, right? So a bankruptcy for Silicon Valley Bank wouldn't transmit to the larger economy because those bank accounts where there's payroll or transactions would be backstopped. But everything else, if you're just a rich guy and you want to put a bunch of money into the regulated banking system and get a return, that's not backstopped. So that's one thing that I think might make sense. I think another thing that might make sense, just because we have these, we fundamentally Dodd-Frank was a failure. We have too big to fail banks. We have government agencies called JP Morgan and Bank of America and so on and so forth. And we have to take those apart. But until we do, you're going to see depositors just run away from smaller banks. Not even the regionals now, the ones at $100 billion and up. Everyone, like people kind of implicitly understand that those deposits are backed. But if you're a community bank, there are 4,000 community banks in this country, or 3,500, something like that. You'll get wiped. I mean, they don't. Janet Yellen, the regulators, they have no problem, wiping you out and hurting your uninsured deposits. So I might be in favor of uninsured deposits for banks that have less than $5 billion or $10 billion of assets. I wouldn't love it. I don't think it's the ideal solution. I think the ideal solution is to get rid of the too big to fail problem, simplify the banking system radically, have much more aggressive asset side regulation, and then you can deal with you can essentially give the full faith and credit of the United States to a bunch of bankers. But that's so that's how I would think about the problem. But I agree with pretty much everything that Saule said.
Professor Omarova, let me follow on that and ask you a question about this idea of like moving forward. So if let's say you were in the job that you were nominated for and Republicans and corporate aligned Democrats had not blocked your nomination, what would you be doing right now? Now, granted, you'd be in a regulatory position, not a legislative position, but even in a regulatory position, what would you be doing regulatorily? What would you be telling Congress to right now, whether it's on deposit insurance or anything else?
Wow, that is a very difficult question to answer, David, because it's a counterfactual. I'm a lawyer. I usually try to shy away from, making these big promises. Oh, if I were there, none of this would have happened.
Well, you were going to be there until the corruption caucus blocked your nomination. So I want to live in the counterfactual world where you are one of the regulators.
I'll say it. If Saule were there, none of this would have happened.
Oh, thank you, Matt.
I mean, we know that. You would have stopped it. But you don't have to.
I don't know. Of course, the OCC was not in charge of SVB or Silvergate Bank or whatnot. But if I were the controller, then my first set of actions would have been really to focus on the supervisory core at the OCC and to really try to kind of strengthen the supervision process and make sure that our supervisors are watching out for various risks. And that they're not afraid to ask tough questions, both of the bank's managers, but also of their own superiors up the chain, including me. Because I think what is missing often from the policymakers, discussions, and again, this is just, I'm an outsider to all of that. But when the regulators and legislators get together, I worry that there is too much of that groupthink of some sort, or at least shared assumptions, and at least this sort of reluctance to really be a difficult person in the room and keep pressing, asking difficult questions. Why not? Why not this? Why don't we have a different way of approaching the issue or whatnot? And that's what I would have brought to the table. How it would have played out in the particular situation would depend, of course, on the circumstances. But one thing I could have promised the people was that I'd be the one fighting.
Julia, you have a question.
Yeah. I wanted to throw a question at you, Matt, because it's been really eye-opening for me, reading about the Fed this week. Obviously, Jerome Powell has been a huge story of the Biden administration because, as listeners probably remember, he's initially a Trump appointee. He's a private equity multimillionaire. He's been on one of the most aggressive rate hiking cycles in American history. And you've been writing, Matt, very critically about the Fed, its role as well as sort of lack of a role in some cases in Silicon Valley Bank's collapse. I'm wondering what exactly sort of a realistic way of moving forward is in terms of, what Congress should do to change the Fed, how Biden's relationship to the Fed should change, should Powell lose his job, what should happen with the Fed?
Well, the one thing the Fed cares about is their independence, right? So the Fed does historically. So I wrote a book about guy, a congressman named Wright Patman, who spent, he was in Congress for 46 years from 1929 all the way to 1976. And for many of them, he spent his time torturing the Fed as the chair of the banking committee. And what the Fed cares about is their ability to have discretion to make decisions, which they call independence. So if you want to get the Fed to do things, you have to threaten to take that. You have to tell them to do something, and then you have to threaten to take that away. So you can do that in many ways. You can say, we're going to have more transparency at the Fed, an audit. We're going to we're going to put you on congressional appropriations. We're going to, because they print their own budget. It's kind of amazing. There's so many dirty things about the Fed. It's hilarious. But there are lots of ways that you can get the Fed to behave. But I think, what Congress should really start doing is, and members of Congress should just explicitly start talking about how the Fed is not independent and needs to be subject to more strict guidance from Congress and the executive branch. And I think if I were the Biden administration, whenever I watch CNBC every morning, and whenever the Biden administration spokespeople come on and talk, they get asked about what the Fed is doing, and they say, well, of course I wouldn't comment on interest rate levels or monetary policy or what the Fed is doing because, we think the Fed is independent, but blah, blah, blah. And then they say whatever they're going to say. But I think they should just drop that charade. And I think they should just, like Trump had the right idea when he was publicly complaining about Jay Powell and interest rates. The president should really be running our monetary policy, or Congress should, someone who's in elected office. So I think that it's important to just drop the charade about the Fed being independent and just start saying the Fed is not independent. And we need to figure out how to structure our monetary policy and our supervisory policy so that they do what Congress wants, and not what they feel like. I mean, there's lots of specifics you could do. Like you could get rid of the reserve banks. They have bankers on their boards, which is insane, and we should get rid of that because that's just a political kickback machine, an influence peddling machine. You could just say, we're going to remove your supervisory authority. You failed, so we're going to move that over to the FDIC, which has an incentive to not allow these messes to be made. At the most aggressive, you could just say, when you make a monetary policy change, you're going to raise interest rates, we need to have the president approve it. Or there's
can I just jump in and just challenge you on one thing? I'm not challenging you challenging you but sort of devil's advocate. What you always hear whenever this idea is brought up is that the Fed chairman or the Fed as an institution needs to be independent so it can make tough decisions without fear of or consideration of politics, political pressures, and the like.
Right. Leave the wallet inspector alone so he can do it.
Yeah. So what's your answer to that? This sort of this fear that some Fed chairman will be too responsive to like what the public wants. What's your response to that?
Well, from 1935 to 1950, we dropped the charade, and the chair was a guy named Marino Eccles, who was a Scottish Mormon. His family was Scottish, and then he was Mormon. He was a Utah banker, and he became the Fed chair. And FDR would tell him what to do, and Truman would tell him what to do on interest rates, and he did it. And we had 1% unemployment, financed the World War II, got us out of the Great Depression. And there really wasn't an inflationary problem. I mean, it was a phenomenally successful, probably the most successful period that the Fed has ever had, was when it was explicitly under the control of the elected leader of this country. So, and that's what the Fed doesn't like people remembering that era. And then really until the late 1970s, the Fed kind of was in this nether region where they kind of took direction, but they could make their own choices if they wanted to. And then it was with Volcker when this kind of notion of the Fed as an independent agency, and it was just wildly inappropriate for anyone to even comment in politics. That's when that emerged. I mean, I think you hear this a lot. Like, do you want Ron DeSantis setting monetary policy? Do you want Kevin McCarthy setting monetary policy? Or if you're a Republican, do you want Joe Biden setting monetary policy? Like, that's outrageous. And I generally, like, you know, a lot of Democrats, I think, we're very happy that the Fed did what they did in 2010 or 2011 because they were like, oh my gosh, the Tea Party Republicans are crazy. At least there's an adult in the room in Ben Bernanke, or the, you know, Republicans had the same, you know, they have the same reaction. And I think what all of that really is it's a distrust of democracy at its core. And one of the things that happens when your Democratic leaders don't have anything to do is it's like any academic, you know, when you have a place with a bunch of academics, like they fight in really bitter, petty ways because there's no stakes. And I think that's one of the things that's happened in Congress and happened with our elected leaders is if the judges and central bankers make all the decisions, then they get to just, you know, fight with each other about meaningless stuff. But like when the pandemic hit and they crafted the CARES Act, there was a lot of stuff in the CARES Act they didn't like, but they did a careful job trying to figure out what to do because the world was on their shoulders. And I think part of what we have to do is say, elected leaders, when they, you know, when you know who is in charge and the voters know it's that guy making the decision that caused a recession, or that guy that's making a decision that caused inflation or brought down inflation or whatever, and I can vote for him or not, or against him, that's a healthy system, right? So like back in the 1920s, Andrew Mellon, you know, was the ex officio chair of the Fed. He was also the Treasury Secretary, and he was a bad guy. He was also a much better participant on the Fed Board of Governors than lots of the other people, because lots of the other people were appointed by banks. It was a slightly different arrangement. The people who were put there by democratic institutions and had some democratic accountability were much more responsive to the public interest, not because they were better people, but because they were institutionally required to be that way. So I think this is more of an institutional question. And every time I say the same, I'm always like, let's replace the Federal Open Market Committee with a congressional committee, or let's have the president set rates. And I always get the same response, which is, oh my gosh, person X, you know, but that would be terrible. But it is basically like we have to decide that we want a democracy. And like, I think that what we see with the Fed is we don't live in a democratic society when these people like Jay Powell are making these decisions. And that's our choice. We're too afraid to let our own people that we elect make those decisions. So we have to just make a choice to want a democracy and say, yes, we want the people we elect to make these choices. So if we don't like them, we can fire them. And if we do like them, we can rehire those people or you know, give them another term. So that's the way I think about it.
Julia, you have one last question for Professor Omarova.
Yeah, I want to piggyback off of that point you're making, actually, David, which is, you know, there's a lot of finger pointing happening right now. I think, David, you've actually pointed out on Twitter a few times, you know, lawmakers who voted for those 2018 deregulatory measures saying like, oh, well, you can't really say, you know, is this exact thing that would have prevented the bank collapse. There are all these efforts to sort of evade.
That's the standard, by the way. That's the standard playbook.
That's the standard.
Yeah, the standard playbook is the standard playbook is to something happens, and then you talk about the context for decisions that were made in the lead up to what happens. And then it's like, well, those things wouldn't directly have stopped this particular. They make it extremely specific to try to make it seem like everyone's to blame, so nobody's to blame.
Well, exactly. And so that's sort of the question I wanted to throw at you, Professor Omarova. Like, point some fingers here for us. Who is to blame? You know, who should be held accountable in terms of, you know, moving forward, holding both politicians and, you know, banking executives or venture capitalists accountable? Like, who should be held accountable here?
Well, Julia, I think we still need some more time to have more information with respect to what exactly happened. Because it's easy, for example, definitely the managers of SVB or Silvergate and Signature, absolutely, should they be held accountable for what they've done and, you know, how many mistakes they've committed? Absolutely. Will they be held accountable? I don't think so. It's easier to hold accountable, for example, the San Francisco Fed and its supervisory department, say, the supervisors missed obvious mismatches in the interest rate exposures and so on and so forth, and that would also be correct. But again, chances are that mostly people down the chain, right, will really bear the burden of being accountable here. I do not know what we can do with respect to those senators or those members of Congress who voted for that 2018 bill, other than vote them out. But again, voting them out, unfortunately, in our dysfunctional political system, requires a lot of money, which we don't have. So when I am completely sympathetic to all these calls for making finance more democratic by making democratically elected representatives make more decisions more transparently, at the same time, we should be realistic about the kind of electoral system that we have. So should we then start with the campaign finance before we get to fixing the finance? Probably so. And I also wanted to just say that I am not quite as adamant about abolishing the Fed or making the Fed directly accountable or directly under the thumb of any individual president. I think that institution is it's performing, or it's supposed to perform, a very important systemic function. In other words, the reason why we do have safe and liquid money, bank-created money, deposit money moving in the system is because of that institutional structure that sits on top of sort of the Fed's balance sheet. Is it doing the job for the sake of all of us that we want it to do? Obviously not. Why is it that when we have monetary policy, interest rate policy is the only tool that would basically combat the inflation and depression and address all of these economic problems we have? We shouldn't just rely on that, right? Nevertheless, that's what constantly happens. Every time some problem arises and, everybody's looking to the Fed, start lobbying the Fed, start pressuring the Fed, and the Fed obliges one interest group or another. It's because the Fed is really the only institution in our political economy that has an independent balance sheet. And this is where the crux of the problem is. It's a hybrid institution in the sense that it is a political institution, but it's also a market actor. And we haven't figured out how to really manage that balance between these two different rationalities. And this is where I think I agree with you, David, and with you, Matt, is we really need to put all of those fundamental questions on the table. We need to start redesigning the institutions of public finance and institutions of our democracy to make sure that we don't just roll, along this path into nowhere.
So listen, well, we're going to leave it there. I want to thank Matt Stoller, Saule Omarova. Thank you to you both. Listeners can subscribe to Levertime Premium by heading over to levernews.com. When you subscribe, you also get access to all of the Lever's website, our weekly newsletters, and our live events. And that's all for the criminally low price of $8 a month or $70 for the year. One last favor, please be sure to like, subscribe, and write a review for Levertime on your favorite podcast app. And make sure to head over to levernews.com and check out all of the incredible reporting our team has been doing. Until next time, I'm David Sirota. Rock the boat. The Levertime podcast is a production of The Lever and the Lever Podcast Network. It's hosted by me, David Sirota. Our lead producer is Jared Jakang Mayer, and our editor is Dennis Golan. You can find all of our past episodes at levertimepod.com or on all of the major podcast players.